Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because you know schools aren't, so let's get started. So if you were looking for dividends or some great companies out there that pay dividends, that's exactly what we're going over in this video. We're talking a lot about dividends, how they are a great way and a very easy way to become rich in the long term. Now, especially if you're like younger, you were probably more focused on growth. However, I still think that dividends are still a great addition to anyone's portfolio, just to keep that kind of more of a conservative risk. So real quick, what the heck are dividends? Well, the reason why so many people love dividends is because when you invest in a company, the stock could go up, it could go down, but no matter what, they still pay you dividends. It provides you an income from your investment. So that's why a lot of people enjoy it. Essentially, you make money from doing nothing, and if you do want to grow that for the long term, when you get dividends, you could buy more stocks, which give you more dividends to buy you more stocks, and that's how you create wealth. How you get rich easy. Now, the structure that I have for this video, I am focusing on 3 stocks and 2 ETFs. ETFs are exchange traded funds. They're kind of similar to mutual funds, so they have like a bunch of stocks in them. So if you don't want to like pick, which one's the best, what's the best company, you don't have to do that. You could choose an ETF. Now, I do have another video going over, I think it was 5 of the top ETFs out there. Kind of just went over the basic ones. So if you're interested, I'll leave a link in the description for you to check out. But let's get into it, guys. First, starting off with a large company. Well, these are all large companies, but this one is Verizon. Everyone, or at least everyone should know Verizon. They are a telecommunications company. And if you have a cell phone, chances are you do have Verizon as a provider. The other one is like AT&T. Those are the 2 top dogs. So we got the chart going on over here. This is their 5-year chart. And you can see that they are fairly stable. Now, yeah, they have ups and downs, but basically where they started 5 years ago is kind of where they are right now. So nothing too risky. So why would people get into this? There's not much growth. Well, like I said before, we're talking about dividends. We could see a little bit further down their dividend yield. They are just under 5%, so 4.9%, so very strong there. Now, their PE, a fair PE for most companies, of course it varies, but people say the average a fair PE could be like, let's say 16, 17, 18 in that area, just to let you guys know. Verizon's PE is around 6.5. So, and then their forward PE, moving the estimates for next year, is around a 10. So it's kind of undervalued at this point. Their 1-year return of last year was around negative 4%. So it went down a little, but you still have those dividends to keep you a little happy there. Now, Verizon has been paying dividends since 1993. That's 24 years, guys. Now, there were some years that they actually decreased the dividend for whatever reason back then. But overall, especially constant growth of dividends, at least for the last 11 years. So they are consistent in that way. Another factor that I like to look at is a payout ratio. What that even means is whatever they're making in like earnings, how much are they paying back in dividends? So if they have like 100% payout ratio, that means whatever they're getting from earnings, they're giving back to shareholders. So you don't want it too high, but like if it's over 100%, that means they're using some extra money somewhere, maybe cash from the balance sheet, so that's not too good either. Verizon's payout ratio is around 31%, so that's actually fairly low, so that's a good pick. Another quick side note, like I kind of mentioned before, AT&T is another great company in this sector. Their dividend is around like a 5.5% right now. So very similar to Verizon, kind of your pick. Of course, remember to do your research before getting into any of these guys. But moving on to our second stock is Johnson & Johnson. I love Johnson & Johnson just because they are so... They sell like everything, basically. I mean, another one is Procter & Gamble. But Johnson & Johnson has like Advil, Listerine. So like even in recessions, they're still selling their products. So they are seen as a safe company. You can see their 5-year chart right there. Very, very nice. Their dividend right now is around 2.6%. So it is a good one. Their PE, I mean their current PE right now is very, very high. I'm assuming just because their earnings have been low recently, but that's at 271, so like astronomical. But their forward PE, what we're expecting for next year, is 15. So I like to look at what's expected for the future, of course. So that's actually a little bit below fair market price if you look at just PE. Their 1-year return was around 3% as well. So this pharmaceutical giant is just incredible. If you saw the chart before, recently it actually took a dip for a couple reasons, so it's not a bad time to actually get in now. But their payout ratio, again, because their earnings recently was low, so their payout ratio is like 700%. But normally it is very safe. Why, you ask? Well, that's because they have been paying these dividends for 55 years. For like the beginning of eternity. It's been very good for dividend holders. Very safe in that perspective. And they're considered dividend aristocrats. I think if you pay dividends for like 30 plus years, you're in that group. So they're definitely in that club. So those guys are more safer. Now, if you're looking for something with a little bit of dividend with some growth as well, I think these guys, I'm sure you heard of them, will be a good pick, is Apple. Everyone and their grandmother knows Apple, of course. So you can see their 5-year chart is just ridiculous. Very, very good. You could see their dividend is not as high as the other guys. Right now they're around 1.4%, but they also have growth behind them as well. Obviously, you can see that from the chart. And they have a ridiculous amount of cash. I'll tell you guys right now, their payout ratio is 25%. So they are easily able to raise that in the future. So that's why I chose them as a good dividend company to get involved with. Their PE right now is 18, so it's kind of fair valued, and their forward is 13, so a little bit undervalued at that point. So that's kind of why I love Apple as well. And their 1-year chart, well, 1-year return, sorry, is around 25%. Now, since Apple is a newer company, they don't have like a 50-year, dividend paying history, but they have been paying it for 5 years. And with the cash on hand that they have, it's a very safe dividend, and I could see them growing for the future. So that's great and everything, but what if you don't know which company to choose from, or if you simply don't care at all? What should you get into? Well, we have a couple ETFs that can help you with that. First, starting off with Vanguard High Dividend Yield ETF, ticker symbol VYM. You can see their 5-year chart, very, very nice. Right now around $84, but you can see their yield is 2.7%, so a good yield right there. Now, one thing that I want to show you guys with this ETF is some of the stocks that they hold. So we could see that they hold huge companies that everyone knows, and a lot of these companies have very good, well, all of these companies have very good dividends because that's what the ETF is, high dividend yield. So they have Microsoft, Johnson & Johnson, like we said before, JP Morgan, and just a bunch of those guys. So all those guys have good dividends, which is exactly what we're looking for. Now, to get a little bit away from stocks and the stock market, if you want to diversify a little bit, there is a way to invest in real estate. you know, you don't need $100,000 to buy a property to get income from real estate. You can buy a REIT, or real estate investment trust. They have very high dividends because by law they have to pay over or at least 90% of their income as dividends. So their ETF is Vanguard Real Estate ETF, VNQ. You can see their 5-year chart. Again, it does not move exactly with the stock market. So if the stock market goes up, this ETF might go down, or vice versa. They are independent things. But you can see their yield is 4.4%, which is exactly why I put it on here, because their dividend is very strong. Quick word of wisdom with REITs. Their dividends are taxed slightly different. So from normal qualified dividends from like a stock, there is a lower tax bracket. You know, you might pay 10 to 15. I think the 15% is max. But for REIT dividends, because it kind of is related to real estate, it is paid at a normal income tax bracket. Not a huge deal breaker, but slight adjustment in rules there. So guys, if you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say, and don't forget to subscribe to my channel, Real Life Money, where we talk about real life and money, because I believe that if we grab a hold of our money, we can stop following the man. So thanks so much for watching, and I'll see you in the next one.